Welcome. Today, we're exploring a really important topic for anyone in the UK thinking about gifting assets. It's called Gifts with Reservation, or GWR for short.
That's right.
And this discussion is brought to you courtesy of the highly respected UK accounting firm, My Tax Accountant. We're aiming to unpack why getting these rules wrong can cause, well, quite a bit of tax trouble down the line.
Absolutely. It's all about making sure your gifts actually, work the way you intend them to from a tax perspective. GWR is a big one where intentions and tax reality can unfortunately diverge.
Okay, so let's dive in. What exactly is a gift with reservation? Lay it out for us.
Well, in simple terms, it's when you give something away, an asset, but you carry on benefiting from it somehow.
Like staying in a house you've gifted.
That's the classic example, yeah. Giving your house to, say, your kids,
Yeah.
but continuing to live there without paying rent. Or maybe gifting shares, but still pocketing the dividends yourself.
So legally it's gone, but practically you're still enjoying it.
Precisely. And HMRC, the tax authority, sees that. The gifts with reservation rules came in back in 1986.
1986, okay.
Yeah, and they're essentially an anti-avoidance measure. They stop people trying to reduce their inheritance tax bill by technically giving assets away while, still having the use or benefit of them.
Right, makes sense. Could you maybe give us a more concrete example, put some numbers on it?
Sure, let's think about someone, let's call her Doreen, living in Manchester. She decides to gift her home, worth, say, £500,000 to her son, Nigel.
Okay.
But she continues living there. Doesn't pay Nigel any rent, just carries on as before. Now, fast forward, Doreen passes away.
What happens then tax-wise?
Well, because she kept benefiting from the house living there, rent-free, that £500,000 value is treated as if it's still part of her estate for inheritance tax purposes.
Ah, so the gift didn't actually take it out of her estate for IHT.
Not in this GWR scenario, no. And with the inheritance tax threshold for 2025-26 at £325,000 and the tax rate at 40% above that.
Let me guess, that £500,000 house could face a hefty bill.
It certainly could. The amount over the threshold is £175,000. 40% of that. You're looking at a potential £70,000 inheritance tax bill just on the house itself.
Wow, £70,000. That's a significant hit, especially if it wasn't expected. Now, what about potentially exempt transfers or PETs? How do they fit in? Is this different?
It's very different. A PET is what happens when you make an outright gift with, crucially, no strings attached. So if Doreen had gifted the house, moved out, and then survived for 7 years.
Then the gift could become completely IHT free.
Exactly. It falls out of the estate calculation entirely after 7 years. The key difference is that continuing benefit. With GWR, the benefit means it stays linked to your estate. With a PT, you sever that link.
Okay, so the core conditions for GWR are?
Two main things. One, you've actually given an asset away. There's been a disposal. Two, you, the giver, continue to get some sort of benefit from that specific asset.
And benefit isn't just living in a house, right?
No, not at all. It could be using a car you've gifted, or like we mentioned, receiving income like dividends from shares you've transferred. Imagine Rajesh in Birmingham gifts shares in his company to his daughter Priya.
Right.
But he arranges it so he still gets the dividend payments. That's a benefit. So when Rajesh passes away, the value of those shares gets added back into his estate calculation because of the GWR rules.
And this is all laid out in law.
Yes, it stems from the Finance Act 1986, specifically Section 102. And HMRC's own guidance, like in their Inheritance Tax Manual reference, IHTM 14301, makes it clear. If the benefit continues until death, the asset is included in the estate.
You mentioned dividends with the shares example. Does the benefit have to be purely financial?
Not necessarily. HMRC can take quite a wide view. Their manual, for instance, IHTM 143301, suggests that even keeping certain rights, like retaining the voting power attached to gifted shares, could potentially be seen as a reservation of benefit.
So control can count as a benefit too.
It potentially can, yes. It muddies the water about whether a truly clean gift has been made.
This really does sound like a minefield. Are there ways to, make a gift but structure it so it avoids being caught by a GWR?
Yes, definitely. The most common way, particularly with property, is if the original owner continues to use it but pays a full market rent.
Ah, so back to Doreen. If she paid Nigel a proper rent for living in the house.
Exactly. If she paid, say, £1,500 a month, assuming that's the going rate in Manchester for similar property, then the gift to the house itself might avoid being treated as a GWR.
But there are catches there too, presumably.
Oh, absolutely. First, that rent has to be genuinely market rate. And importantly, it needs to be reviewed regularly, maybe annually, to ensure it keeps up with market changes. You can't just set it once and forget it.
Okay, keep it realistic and current. What else?
Well, think about Nigel. That 1,500 pounds a month is income for him.
Ah, so he has to pay income tax on it.
Yes. Depending on his other income and tax bracket for 2025-26, he could be paying 20%, 40%, or even 45% tax on that rental income. So solving the IHT problem for Doreen creates an income tax issue for Nigel. You need to weigh that up.
Right, it shifts the tax burden potentially. Are there any gifts that are just automatically exempt from GWR rules? No strings, no worries.
Yes, there are some important statutory exemptions. The big one is transfers between spouses or civil partners. Those are generally exempt under FA 86S 1025.
Okay, that's useful. Any others?
Gifts to registered charities are exempt. Also, gifts to political parties and gifts to registered housing associations. These fall outside the GWR rules.
Could you give a quick example of the spouse exemption in practice?
Sure. Let's say Doreen, instead of gifting directly to Nigel, transfers her house into joint names with her husband, Malcolm. They hold it as tenants in common.
Okay.
That transfer from Doreen to Malcolm is GWR free because they're spouses. Now, if Malcolm were to pass away later, perhaps leaving his share of the house to Nigel in his will, that pathway avoids the initial GWR issue for Doreen's transfer to Malcolm.
Interesting. Now, what about business owners? This must intersect with things like business property relief, BPR.
Oh, hugely. This is a really critical point. BPR can offer very valuable IHT relief, sometimes 100%, on business assets. But if you gift those assets and trigger the GWR rules by retaining a benefit,
You could jeopardize the BPR.
you certainly could.
Yeah.
HMRC might argue that because you're still benefiting or retaining significant control, the asset wasn't fully transferred for IHT purposes, potentially impacting the BPR eligibility. There have been estimates, figures mentioned like 128 million clawed back by HMRC in a year from arrangements, including GWRs, that didn't quite work as planned, often involving homes or businesses.
So, trying to be clever with business assets could backfire badly.
It requires extremely careful planning, yes.
Yeah.
You don't want to lose valuable BPR and get caught by GWR.
Okay, so pulling this together, what are the absolute key steps people should take to avoid falling into these GWR traps?
The fundamental thing is, make a clean gift. That means genuinely giving it away and retaining no benefit. Full stop.
So for property,
You either move out completely, or you pay a full, properly reviewed market rate if you stay. No shortcuts.
and for shares or other assets.
Relinquish all benefits. That includes income, dividends, usage rights, voting rights, anything that could be seen as you still enjoying or controlling the asset.
Documentation must be vital too.
Absolutely critical. Keep clear records, what was gifted, exactly when the gift was made, and proof that you ceased benefiting from that date. You need evidence if HMRC ever asks questions.
Can you think of a case where failing to do this properly led to problems?
Well, you hear about situations. Imagine, say, Susan from Leeds. Gives her £600,000 home to her children, but carries on living there. Maybe helps with bills, but pays no formal rent. She passes away, perhaps within 5 years.
GWR applies.
Very likely. The house value is pulled back into her estate. That's £600,000 less the £325,000 threshold, leaves £275,000 taxable at 40%. That's a potential £110,000 IHT bill on the house alone.
Ouch, and that could potentially have been avoided.
Yes, if she'd paid proper market rent, or if she'd moved out. If she'd moved out and lived 7 years, it could have become a fully exempt PT, potentially saving all that tax.
Wow.
It highlights the importance of getting the structure right from the start.
It really does. So, wrapping up, the big takeaway here seems to be caution and clarity when gifting.
Definitely. The key message is a gift with strings still attached, where you keep a benefit, usually isn't a true gift in the eyes of the inheritance tax system. It likely remains part of your estate.
It sounds complex, and the stakes are clearly high. If someone listening is thinking about making significant gifts, what's the best course of action?
Given the complexity, the potential tax implications, and just getting it right for your family's future, seeking professional advice is really essential.
And my tax accountant who arranged this discussion, they handle this kind of thing.
Absolutely. Firms like my tax accountant specialize in this. They understand the nuances of GWR, PETs, BPR, and all the interactions. They can provide tailored advice to help you structure gifts effectively, ensuring they match your intentions and are as tax efficient as possible within the rules. Getting that expert input up front can save a lot of trouble and potentially a lot of tax later on.
Excellent advice. Thank you for clarifying that.